but we're talking about utilizing life insurance in retirement today. It's a topic I think more and more people are starting to focus on. We know that the cost of healthcare just keeps going up and inflation's going up, but how can you utilize life insurance to kind of even that out? So we're going to talk through that today. This is interactive, so please unmute, talk away, ask questions. We'll do our best to answer, but we'll get started. So here's what income retirement looked like in the past, right? You had your nest egg was the smallest piece because you depended on that pension. And then you had the Social Security there in the middle. Today, it's that nest egg that has to be the largest piece with Social Security and then a pension. So the number of traditional employer pension plans has decreased significantly over the last couple of decades. So there's a greater need now than ever for an increased personal saving and investing wisely. So how do you go about doing that? Well, again, with that demise of the pension plans and an uncertain, sorry, a frog, future of Social Security, a lot of people now have the responsibility of creating their own retirement income, right? And they often rely on money assumptions. So they assume a certain rate of return on their investments, an assumption rate of inflation, and an assumed life expectancy. And it kind of ignores the fact that the markets fluctuate, inflation isn't steady, and now you really don't know how long you're going to live. So now we have to take some of those risk factors and roll them in when we're talking to people about how they can best plan for retirement. Here's a slide showing the inflation rates from 1990 to 2022. Most of these slides I borrowed from Prudential. They offer them for us to use, and I picked apart a presentation to share these with you. Granted, this is 2 years ago, and the inflation hit 9.1% in June of 2022. That was the highest level in 40 years. Think about where that is today. We're talking 2 years ago. I think we've all seen a change in our grocery bill. I think that's the biggest one that I've noticed. Everything seems to be going up, but how worried about our clients about inflation? They're pretty worried. They're wondering how far their dollar is going to go in the future. This was, again, a slide from 2022 about how inflation has impacted their lifestyle. You're going to see that they cut back a lot on dining out and plan trips a little bit smarter as far as how far they drive, maybe canceled a monthly subscription, started to kind of watch where they put their dollars. I can only imagine how that's shifted now. Anybody who has any kind of social media can see a lot of people are being kind of vocal about what they've had to cut back on given the inflation that's currently impacting us. And then especially, how does that affect the older retirees? Again, we have to remember that healthcare piece. We know healthcare is never going down. There is that Medicare piece of it, but then there's always cost above and beyond that Medicare. So how do we make sure that they have success in their planning? These next couple of slides really hit me. And it was talking about your reduced purchase power because of inflation. So depending on the inflation rate, at 2%, if there's a 2% inflation rate, you have 33% less buying power. That's a pretty big translation. When we get up to where they said we were at 9 in 2022, this chart doesn't even go that high. It means you have 71% reduced purchasing power, which translates to what was $100,000 worth. So what $100,000 worth was 50 years ago, obviously has changed to today. But with the current inflation rates, what will it be worth? This column is just crazy to me. If we stay with the inflation where we're at now, at even like 6%, in 30 years, $100,000 only gives you $15,000 of purchasing power. That's big. I think that's a huge thing to keep in mind. So here we talk a little bit about longevity, about how the retirement journey could last a little bit longer. Some stats that were interesting on this: more than 2/3 of Americans living to age 85 or older are women. More than 2/3. 8 out of 10 centenarians are women. And 50% of women will live past 90, 25% will live past 95, and half of the women that are over age 65 will outlive their husbands by 15 years. So just knowing those statistics when we're talking about life insurance and retirement planning can be powerful. So we always talk about how can we manage that risk? We know what the risks are. How do we manage it? You can avoid it, you can retain it, or you can transfer it. And today we're going to dig a little bit deeper into the transferring of that risk. So in using life insurance, you can access the cash surrender value. You can set something up where it has dividends paying out as an income. You can look for the additional protection offered by products that will provide an upside potential and downside protection. So maybe looking at like an IUL or a UL where there's a floor if they decide to look at the markets, but then it has unlimited upside potential. Using life insurance to protect a surviving spouse against inflation. So really making sure that you're setting up that risk as such. And then also the tax benefits of a life policy, which we'll get into more here on this slide, is having a lifelong death benefit to meet protection needs. You have that tax deferred cash value accumulation. That's when we talked a little bit about setting up a plan that offers dividends during retirement years can be a really nice way to offset some income there. There's tax-free income potential generally. You can use life insurance to hedge against premature death and an increase in taxes. It's exempt from Medicare surcharge, doesn't affect taxation on your Social Security, and you have access to use and control the policy cash values. So there are quite a few benefits to looking at incorporating a life policy in planning. We're going to walk through an example of Don and Kathy. I really appreciated this. They're both age 65. They have a daughter, Barbara, that's 30. They have 1.5 million in an IRA and $1 million in investment assets. They have income coming in from a pension plan and from other assets that meets their income needs. So they don't need to draw off of these. They had set aside 500,000 of IRA assets as legacy money already. So it intended to move that aside to make sure that that was providing a legacy, moving on to Barbara. Here we're looking at if Don at age 65 put that 500,000 of his IRA into an account, naming his wife as beneficiary, followed by Barbara. Even if he took appropriate RMDs and everything, he would leave an account worth $738,000 to his wife until his death at age 80 and until her death at 83. In between, she would be taking the appropriate RMDs. So they would be able to, again, setting aside 500,000 in this account. They would have taken over 397,000 in RMDs. So Barbara would actually at the end have $723,000. And what does that look like when we look at it? So it's invested here in an IRA. The 723,584. Again, her parents set that aside. They drew their RMDs and things that they needed from it. But then there's this income tax of $222,000, leaving her basically what they had intended of the $500,650. But what if we looked at that a different way and we put some of that into a survivorship life insurance? How would that look? How would that impact their legacy plan moving forward? So let's say that they took 20,000 in out of their IRA annually and put it into a survivorship guaranteed universal life policy. Let's see kind of how that would look. So they have invested, let me go back because that was wrong. They have invested into a survivorship life policy of 1,346,726. They still set up that $500,000 IRA, but they withdrew $20,000 a year to put towards that life insurance. So here's the first scenario we talked about with the IRA value of 723 minus the income tax, leaving them 500,000. If we look at the protection strategy instead, their IRA still has a significant amount in it of 358,000. Their tax load is so much less, and they have that death benefit. So instead of leaving that legacy of 500,650, they're instead leaving a legacy of over $1.6 million. Still drawing their RMDs, just taking withdrawals and putting it towards this policy. You can see how there's some ways to play with life insurance and retirement. And again, we're going to dig in further to this. We have a life mastermind actually coming up where we're going to dig pretty deeply into advanced markets and strategies. That starts in April, and we'll be sure to send the invite out to all of you. That'll be once a week, but we're going to dig into this a lot more of what do those distribution life plans look like? How do you structure them? What's really available? And then how can you make this work? And also, even with this, in life policies, there's so many options to add that chronic care or critical care rider so that if long-term care is needed, again, they're not having to access these funds. They are able to leave the legacy that they planned. So in summary, like, you can help your clients prepare for predictable risk for retirement income. Sorry, got that completely backwards. And talk to them about the risk that offers some downside protection, but upside potential. And understand the importance of comprehensive retirement and estate planning and the benefits of life insurance. I will share this slide deck with all of you so that you have them, because I just felt that there was some really impactful information included in that. Does anybody have any thoughts or comments on what we just went over? I know it was a quick, big overview. That's typically what we do at Webinar Wednesdays, but I hope it gave you some things to think about and to look at moving forward.
That was a very good presentation. I look forward to taking a look at the slides and analyzing that a little bit more.
Yeah, and let us know if you have any questions on it at all.
Absolutely, not afraid to ask.
That's great. That's great. And Juniper, is our mastermind invite, do we have that scheduled yet or not yet?
Not yet, but it will be shortly.
Okay, so once we get that ready too, like I said, every week in April for an hour, we'll be digging in deep with different carrier partners to really go through these concepts and show you how you can utilize them in your practice. So we're pretty excited about that. Any other questions? I know this was really quick, but
that's okay. Great things come in small packages.
well, thank you so much for joining us.
Absolutely. Thank you very much.
Yes, I hope everyone takes care. We'll be sure to get the slides out to you with our thank you for attending today.
All right. Thank you so much.
Thank you.
Okay. Bye-bye.
Bye.
Bye.
Have a great day.